Talk to us about sort of these further 75, maybe 100 basis point rate hikes that we could be expecting, what that means for your world of value equities.
Yeah, and I think as interest rates continue to go up, you're going to see valuations compress like you have already. It's always hard to kind of know how far are we through this, but my expectations are we're probably in about the 7th inning of the sell-off. I think if you look at earnings next year of 250 for the S&P, give or take, and right around a 13, 14 multiple at this point feels about right to me. If it's just going to be a mild recession, that's going to put you at 33, 3,400, and I think we're getting there. And I think the good news is I think 23 is going to be a lot better than 22.
Okay, so if we're in the 7th inning of the sell-off, don't know much about baseball. I know there's 9 innings, though. Where is the end of the 9th inning on the S&P 500, for example? At what point would you say, okay, we've probably bottomed here?
Yeah, and that's kind of where my analysis in terms of, I kind of feel like 33, 3,400, unless there's some other extreme things that happen at this point in time, because the pessimism, and myself included, I think most investors are pretty pessimistic. We've seen major sell-offs in pretty much every sector this year. So that kind of feels, but again, the consumer balance sheet's in good shape, corporate balance sheet's in good shape. And we're kind of preparing for this storm ahead of time, where usually the worst storms are the ones that surprise you and kind of hit you all at once.
Shelley?
Yeah, sorry. I'm just thinking about that 33, 3,400 number here. We're about 38 right now, just about. It makes you more bearish also than some of the strategists we're seeing out there on Wall Street. We're seeing revisions happening pretty significantly here. Yeah. So all the people that look at 3,700 and salivate over it and are buying into this dip, do you think they're wrong?
Yeah, I think my average time horizon is 5 to 7 years. So it's to me to be within 10% of your downside. That to me seems pretty attractive because it's always impossible to pick the bottom. So, to be salivating at these levels, do you want to start to average in probably at these levels? Possibly, because the market is down a little, a fair amount. But I do think the complete downside would be more around that 33, 3,400 level. But that's only 10% away, so it's not that far away. And it's always hard to precisely time the bottom of the market.
Kevin, some of the more interesting conversations we've had on this program is the cross-asset signals that you and equities are looking for, namely credit. And a lot of people have said the fact that high yield hasn't blown out, spreads haven't widened, is actually bad because the Fed means they can move faster and they can move more because you're not seeing sort of these blowout credit spread widenings. What other sort of cross-asset signals are you looking for and taking when you think about your world of equities?
Yeah, it is hard with the bond market right now when you see yields moving around 40, 50 basis points on a very short term. So, I really do think as we look at the inflation numbers month over month is something that we kind of need to look at this point. Oil's down a lot over the last 4 to 6 weeks. I think that's going to make the July numbers look a lot better than June. Natural gas prices have come in. I think that's going to be an important indicator. With that said, wage inflation and food inflation, I don't think is going away or going to even or improve anytime in the near future. So you have a lot of cross currents going on in the market. And wage inflation isn't necessarily bad as long as we can get some of these other cost components under control.
How likely do you think that is, though?
I think you have to go, and this is kind of where what we get paid to do, is you have to go industry by industry. So I think food prices, until the Ukraine-Russia situation rectifies itself, we have 20% of the world's wheat supply coming out of those two countries. So and that feeds into a lot of food stocks. So that's going to be a complicated issue. I think oil and gas, it's supply demand. As more of these sanctions go into effect in the back half of the year, primarily for gas, but for oil too in Europe, that's going to probably put some upward pressure on those commodities once again, given the dislocation of some of the Russian supply. So you do have a lot of cross currents. It's in some ways, it's never been more complex.
Kevin, double down on the energy cross currents in particular, because energy is the only sector in the green on the year for the S&P 500. And so if you take that into account here, what is the risk of being wrong on energy? If the economic situation deteriorates such that energy comes under bigger pressure than you're saying, then what happens to the S&P?
Yeah, so I think I do think energy could come under some existing pressure. The good news is we have a supply limitation in the industry now at around $75 a barrel.
Yeah.
So I think we're in better shape on that, and it's a small part of the S&P. So I don't think energy in and of itself is going to really derail the S&P.